Well, good afternoon and welcome to LIBOR's Wednesday webinar. My name is Mary Ann Monteleone, Director of Education for LIBOR, and we have two great informative guests here with us today from the National Association of Realtors on FEMA initiatives, getting the facts about Risk Rating 2.0. Let me take a moment to formally introduce our guest, Cindy Hayden, who will then introduce Austin Perez. But first, Cindy is a successful full-time broker associate in the Tampa Bay area. She is a recent graduate of the NAR Leadership Academy and is known for being a champion for homeowners in the area of homeowners insurance, flood insurance, and sustainability, and served on NAR's President Vince Malta's Sustainability Presidential Advisory Group, or PAG, in 2020. She became very passionate about insurance when Biggert Waters happened in 2012, and she has been advocating ever since to ensure there are affordable flood insurance solutions, including the NFIP, remain solvent and sustainable. Cindy was named her association's 2021 Realtor of the Year and also received their prestigious Advocacy Champion Award. Cindy served as Florida Realtors Insurance Chair in 2017, as well as serving the last 3 years on NAR's Insurance Committee. She will be the Vice Chair of NAR's Insurance Committee in 2022, which is this year, and currently has been active in educating Realtor members and consumers on NFIP Risk Rating 2.0. So without further delay, I'd like to welcome and introduce Cindy Hayden.
Thank you so much, Mary Ann, and it's a pleasure to be here. Like I said, we're excited. I am one of you. I deal with this every day. And Austin, do you have the slideshow for us? Awesome. I'll tell you more about my partner today, but we put together this this Risk Rating 2.0 back in September. All of us were kind of curious about what was coming, how to educate ourselves as well as educate the consumer on how to navigate it, and have had a real pulse on it since then as new policies started becoming using this new pricing model in September. And then in April, now your current clients with NFIP policies will be seeing that in their renewal policies. Go ahead, Austin. So Mary Ann did a wonderful job. It is my honor and pleasure to be here with you today. Go ahead, Austin. So I'm going to give you a little bit overview of kind of why, how I got here and those kind of things. And then, what's happened in the process. We're going to have Austin then talk about the legacy system. We'll talk about Risk Rating 2.0. We even ran some numbers on how it's impacting, Queens, Suffolk, and Norfolk County. So, give you kind of a sense of that, and we can, take a dive on that. And then, what resources are there and what you need to know. Go ahead, Austin. So, you're probably saying, how did a nice girl like me become a flood insurance geek here in the Tampa Bay, Florida area? We have this crisis, and up here you can kind of see that as we've had things progress, the costs have just escalated to a point where it's not sustainable. And so we were, again, we don't have to be rocket scientists to know that, the money paid in and the money paid out was very different. Just to tell you a little bit quickly before we go forward is, there are three things that really made me realize how important insurance is to the resiliency of families that we serve and to ourselves. One is that almost 30 years ago, I lived outside of Philadelphia and had a house fire, and I lost everything. And while there are baby pictures and college memorabilia and all that I will never have again, what I did have was an insurance company that made me financially whole and resilient again and got my family, back in my house. My best friend from college then lived through Hurricane Andrew in Miami. And I saw her, luckily she was a lucky one, and got an RV and lived in her front yard for 2 years during the reconstruction of everybody hit there. And then the third thing that happened was bigger waters happened in 2012. And I happen to live in Pinellas County, which is the Clearwater, St. Pete, Tampa area. But my particular county, Pinellas County, we are an older home. A lot of our homes were built in the 50s and 60s and 50s, 60s, 70s. Anyway, before NFIP, standards were set. And so we have a lot of homes that sit right on the ground in flooding prone areas or, modeled to be flooding prone areas. And so we are the largest of grandfathered homes. We had 57,000 that were paying a reduced rate under the old system. There's a lot of concern about what would this do? We knew there was a problem, but then the question is like, what do we do? And in those times, I don't know if any of you put in the chat, if any of you were around in bigger waters and maybe you sold a property like I did, where I had a veteran buy a home, did everything right. And then Congress actually took the bigger waters and rolled it back 6 months. So it passed in like September, but it went all the way to anybody that bought a house in, say, March. So this person said, basically they got the new flood rate, and on this, 1,200 square foot home, their annual policy was going to be $14,000, and it had to be paid. It couldn't break up in payments, couldn't raise your deductible. I mean, and he looked at me and said, we did everything right to get our dream home, and basically the government's foreclosing on us. And so we knew that's not what we wanted to do again, but just to show you bigger waters, go ahead, Austin. If you didn't have a sense, this is what the former chair of the insurance committee actually had happen in Georgia when bigger waters occurred. He had a structure, and if you look to the right-hand side, it was worth $300,000, right? The cost of the insurance was $300,000. His flood insurance bill alone was $87,574. Now, I don't know about you, but again, if that happened to me and my family, I basically lost the house. And he actually did end up selling the property, but he was one of the people that led working with Austin, since 2012 to say, we've got to do better. There's got to be a better way. We understand the issues, but we also need to have a seat at the table to be part of the solution, to defend and advocate for our communities. So, tell me if any of you saw high interest rates in the chat. You can mark and what you saw, and if any of this sounds familiar. Again, I know you guys have almost 96,000 people in your area with NFIP policies, but they could be newer construction. Maybe you didn't see as much of an impact. I'm not sure. Go ahead, Austin. So this kind of tells you the timeline. So when this happened, NAR actually put together our insurance committee to address this. Prior to that, NAR did not have a formal insurance committee. We did, as the largest trade association, work to get Homeowners Flood Insurance Affordability Act passed, which actually created the glide path that we'll talk about later. It put caps on how much your primary or secondary could go up, and it created deductibles and other things. And so most of us that are selling real estate in the last 10 years are using these things, or the last 8 years are using these tools and are familiar with what the system was. But in 2021, after a lot of work, and you're going to hear more about it, FEMA rolled out Risk Rating 2.0. What I'm super proud about, and again, just always love to remind people, is it's just one more thing that we don't always see on the forefront of all the advocacy work that NAR and RPAC investments have done to help us have a seat at the table and make sure that we could come up with a solution that met the goals of being equitable and viable long-term. So at this point, go ahead, Austin. I want to turn it over to, we sometimes lovingly call him the flood man, because again, as you can imagine, since 2012, he has invested so much in this and is a wealth of knowledge and a great resource to our members. It is my honor and pleasure to get to work with him as I serve on this committee. And he's going to share more about the legacy system, where we were and where we are now. And hopefully then you'll be able to understand and share that. So take it away, Austin.
Thank you, Cindy. First, let me take a step back a little bit. I am staff in Washington, D.C. I talk with members of Congress and staff with FEMA, other federal agencies on your behalf. And sirs, it's a privilege to be here today with you. And thank you for the dues dollars that you help us to have a building on Capitol Hill, the resources that we have in order to be able to educate members of Congress and federal agency officials. We just really appreciate the opportunity. And as you can tell, as staff director to the insurance committee, who's been sort of behind the scenes as staff throughout this entire process, I have wonderful volunteer leaders, 50 of them, including Cindy, who's my vice chair this year, will be the member chair of the insurance committee next year. I'm really excited about that. I have a wonderful group of members who probably have forgotten more than I will ever know about flood insurance. I mean, these are your peers, members who are living, breathing, sleeping, selling in and around special flood hazard areas daily. So they know just about everything it is. And I mean, as you heard from Cindy's really powerful stories, these are members who are directly infected. They're not sitting at a desk in Washington, D.C. like me and reading testimony or writing testimony or talking points or whatever. So it's wonderful. I appreciate the opportunity. Cindy asked me to talk a little bit about where we were before to provide you some context before we get into the specifics of what is risk rating 2.0. Need to, rewind a little bit, go back. And specifically to that rate quote that Cindy pointed out, $87,000 per year for a $300,000 home is ridiculous. You can't find any actuary, those are licensed professionals who develop insurance prices for insurance companies and for FEMA. No one could defend that number. So after the 2012 Act, and we saw rate quotes in the tens of thousands of dollars a year up to that $87,000 number, the members were upset. Our board of directors were up in arms. How could it be that a $300,000 home could have an $87,000 premium? That would mean that if actuarially you were looking at it, that house would be expected to be total loss, washed away once every 4 years. I can assure you, having worked with members and owners who are selling repeatedly flooding properties, there's not a single one that are reaching $87,000 per year in losses. They are on the ground. They are not being lost once every 4 years. So this, I think, when the insurance committee was formed and it was authorized by the board of directors, they asked me to be the staff person to direct the committee, to learn everything there is about it. And we learned very quickly the 50-year-old system was so complicated that we were going to need help. And so we went back to the board of directors, the leadership of the committee recommended the board finance some research, what happened first, and then get into what should we do now? What should the solution be to what we learned? That was happening back right after 2012. So what I'm going to share with you is some of the slides that we got from the actuaries, from the experts that NER hired, thanks to resources and your help and the approval of the board of directors. All right. So the legacy system is just the old system. It's the system that was in effect before this year. Risk rating 2.0 took effect October of last year for new policies and is in effect for renewal policies today going forward. The previous system, the previous system that FEMA used in order to price insurance rates, they call that the legacy system. Okay, so what do you need to know about this? I don't know how many of you have been in the business 50 years, but the thing that you need to know about the old system, why they came up with an 87, how it was possible they came up with an $87,000 premium for a $300,000 property, is because at the time the pricing system was created 50 years ago, this is the kinds of technologies that you would likely see. There were no handheld device. There was no internet, no websites. What there was is a rating manual, which looked like a phone book that you put on a desk and insurance agents would flip over and they'd have to look at the right table in the right part of that phone book in order to come up with the rates. Those rates were based upon two pieces of information. Is the property in or outside a special flood hazard area? These are areas on FEMA's maps where there's a heightened risk, a 1% annual chance that the property is going to flood. And what is if you are in one of those SFHAs, how high is the lowest point of your building where it touches the ground, the lowest adjacent grade relative to the base flood elevation, which is FEMA's estimate of the 100-year flood level, how high the flood waters would rise in a 1% annual chance event. So going back, for those of you who have been in the business 50 years ago, and I've heard stories, I was not staff 50 years ago, about, how you would do listings, and there were no lock boxes. And so you would have an agent who would sit at a payphone with quarters and dimes in a cigarette tray, and you'd wait for calls for someone who wanted to take a look at a house. Or someone would come in and they wanted to look at a house, and then you would pick up the phone and you call the agent on call, and the agent would meet the prospective buyer in order to walk through the property. That's the way things were. The MLS was not on a website somewhere. It was also a phone book that looked on. So think about how much technologies have advanced over time in the real estate industry. If your clients were asking you to serve their interests and you could only use technologies from 50 years ago, I don't think your clients would stay with you for very long. Moreover, if all you could give them was two pieces of information about a property before they made the decision, probably the largest purchase of a financial asset decision in their lifetimes, if you told them, I'm sorry, but all I can tell you is the address and the number of square feet. I can't show you the property. I can't show you where it's at, the schools nearby. If it's 1 or 2 floors, I can only tell you 2 things about this property before you make this largest financial decision of your life for most people. I don't think you would be in business very long. That's what FEMA was dealing with, and why the $87,000 for a $300,000 home came up, because it was state of the art 50 years ago, the technologies that they had, but it is no longer state of the art, and 2 pieces of information based upon 50-year-old technologies no longer cuts it in this market. So that's point number 1 about the previous system that's being replaced by Risk Rating 2.0. Second, I don't know how many of you who are selling in and around special flood hazard areas have seen a picture like this. This again is the 50-year-old system. There are these large cliffs in prices, even though the risk hasn't changed that much. And here's an example right here in Pinellas County, where you have one property under the 50-year-old, the previous system, a $6,000 premium, and the other one across the street, $400. So a $6,000, a $5,500 difference across the street. And water doesn't obey lines on a pavement. I think we can all agree that risk probably has not dropped by $5,500 by just walking across a street. Water doesn't follow boundaries on a map, but this is the 50-year-old system. Some rates are very high. Other rates right next to it are very low. And here is an example of that. Plus, I want you to look in the lower left-hand corner of the 50-year-old system. The purple area that you're seeing is the special flood hazard area. This is the area with the 1% annual chance, the 100-year flood zone, where you're required to get flood insurance for a federally related mortgage under federal law. You can see that the first dot, risk 1, and there's sort of on the lower left-hand corner, you can see that the risk 1 is sitting in the purple area, the special flood hazard area. That's this house that you're looking at the top of the screen on the left. Risk 1 is the house that you see that's paying $6,000. Just to the right of it, you see the risk 2. That's the house across the street that's paying $400. What you can see is if you go to sort of the top right corner of the lower box, you can see a risk 3. That's a house about, I don't know, what is that, 4 blocks away from this house here, these 2 houses, the risk 1 and risk 2 houses. You can see that risk 3 is also paying a $400 premium. What's the takeaway from this? Not only do you see very small, very large jumps in premium under the system, even though the risk hasn't changed very much, but the premium does not change. How far away, no matter how far away you go. If you continue to track to go out, take risk 3, and let's go another 1,200 miles to Columbus, Ohio, and you will find that exact same rate. Whether you're in Pinellas County, where the main source of flooding is storm surge off a hurricane that's water velocity, which is much more damaging, much more costly to repair, that the program would have to pay out and repair under a claim to the NFIP, is paying the same rate as a property off a river in Columbus, Ohio, where the main source of flooding is riverine and its water level rise. Water rising into a house does not cause as much damage as water that roughly 1.5 feet of water can knock you off your feet. So put a wall and 1.5 feet of water, you can knock over entire buildings in Pinellas County, but the two are paying a very same rate. Okay, so, and I can go on and on about all the problems with the 50-year-old system, but just to give you a sense of the system that's being replaced, I wanted to point out sort of the 3 glaring problems we saw with the previous system. So the board of directors, after the insurance committee was formed, asked the insurance committee to come up with NER policy position. What do we want in a new system? Okay, now that we know the old system is outdated and broken, what does the new system need to look like? And they authorized me to go find and hire actuaries, not only to review the previous system and is it really that bad? And it is, but also to come up with a solution. And so they gave me the criteria. What is it we want to see in a new pricing system? So the first thing, Risk Rating 2.0, actually started out as research that we funded. The actuaries we hired, Milliman, we got a lot of money in order to come up with a solution, and it's still on our website. Back from 2015, Milliman, the company that we hired, developed a study. What would you do if you were to apply modern science, technologies, and data like the private sector currently does, but apply it to NFIP rates? And so the first thing they did is they came up with this analysis, and we looked at it, and the board of directors adopted policy. The first criteria was it has to be based on science and it has to be based on collaboration. Why is that? Well, the $87,000 per year for the $300,000 home is not based on any science. It's not based on any collaboration. In fact, we're not even sure. There are very few people who have been at FEMA 50 years. Actually, it was at HUD before FEMA. Very few people who know what the program was like, and you can't really figure out what science was used in order to come up with that $87,000 rate. It's a black box. So when FEMA decided to go on to replace their insurance system, in part because of the research we provided them, they also decided to hire the very same actuaries that we hired in order to build out. So they collaborated with and worked with Milliman in order to build out their system. I have some, information here to show that it's based on science and based on a collaboration. What you need to know is these are PhD building experts, scientists, actuaries. A team of them came up with this system. Yes, we have been collaborating with them. The insurance committee has been talking with FEMA. I mean, I think we've met with them 20 times in the last 5 years to go over their progress and work and offer feedback and exchange. But you can see that the new system, the Risk Rating 2.0, is actually based upon the first criteria the board of directors at NER adopted, which it needs to be based on collaboration and science. Second, and I hear more complaints about this, why would you price rates on a flood zone? Why wouldn't you do it individually? As you know, your clients, they want to know about a specific property. When they ask you about the schools, they don't want to know about the schools for the county or the state. They want to know about how many schools are down the street. Is it a school district? They want you to get very granular with the information that you're providing about a specific house. They want to know the utility bills, not the average cost in a neighborhood. They want to know the utility bill for the specific house. So the second criteria was it should be property specific. Not only should it be based on science and collaboration, but it should be based upon the specific building that's being insured. A property owner with a building should not be paying a rate based upon what the guy 300,000 miles away the risk to the guy 3,000 miles away. It should be based upon the risk to the building that the property owner owns. Risk rating 2.0 provides that building specific rate. Moreover, it's not using two pieces of information like the previous 50-year-old system. It's using more than a dozen factors relative to each individual building. So it's an individual building price, and it's based upon a dozen variables about that individual building. Distance to water. How high is the building relative to the sea level? What's the major source of flooding? Is it riverine? Is it tsunami? Is it storm surge? Is it urban flooding? A lot of the maps don't account for flooding away from water. So this does. It accounts for backup of sewer systems when you have heavy rainfall, like in the Houston area. So these dozen variables for each individual property is what the new rating system is being based on. So this, check the mark. The second criteria that the insurance committee, as adopted by the board of directors, directed me as staff, go to FEMA and get us a rating system that is science collaboration and individually rather than by flood zone. Lastly, technologies and standards. Since 1992, the private sector has been using things like replacement cost value, pricing things individually, using natural catastrophe modeling. So all of these standards are being applied to risk rating 2.0. Checkmark 3, the third policy principle that the board of directors have directed that we want in a new rating system, and risk rating 2.0 meets that criteria. And just to give you a sense of how different the old system and the new system is using these technologies and standards, you can see that under the 50-year-old system, if there was no risk rating 2.0, if we rewound the clock and FEMA decided not to take the advice of the insurance committee and work with us in order to develop a new system, the previous system that was replaced, that is no longer in effect, if that had been allowed to move forward and nothing happened, it was just status quo moving forward, you can see that on April 1 of this year, 92%, the legacy system, 92% would see a $0 to $10 increase. Another 4% would see a $10 to $20 per month increase. And then another 4% would see an over $20 per month increase in flood insurance premiums. So the thing that you need to see about this is everyone's rates went up under the previous system. None of them went down. Every year they continue to climb into perpetuity until they reach that $87,000 number. That may not be something you are aware of. It was something that shocked me to find out. I did not know that. That's something that the experts at Milliman pointed out. So how does the risk rating 2.0 compare with that? Well, you can see for the first time in the 50-year history of the program, 23% are actually going to see a decrease in their insurance premium after April 1. And the average premium decrease is about $800. That's, $80 a month. So you're talking about a $1,200 decrease that about 1 million policyholders will see after April 1, which is already passed, are already seeing those increases. You can see for another 66%, they're going to pay in about the same range that they were paying under the legacy system. Another 7% were paying about the same as the 4%, a little bit more than what they were paying under the old system. And another 4% will see, more than $20 per month increase. So let's focus on that 4% under risk rating 2.0 versus the old system. So we asked FEMA, what's the top rate in the program? So the program, you could see in 2012 as high as $87,000 per year. We went to Congress, we delayed, we rolled back the premium for a couple of years and put it on a glide path. So no one jumped to that 87,000 overnight. They would go back to their previous rate and then they would increase 18%, no more than 18% per year. So we asked FEMA, okay, they're on a glide path. They're not jumping the $87,000 rate. What's the highest premium being paid in the NFIP this year? And the answer is $45,000 per year. Those property owners in the largest category, the more than $100 per month increase, there were, under the old system, about 40,000 of those. Under the new system, there were only 3,000 across the entire country. So that 4% is masking that for the highest, the policyholders who are seeing the highest premium increases in the program at that $45,000 headed to $87,000 per year. Under the new system, there are fewer of them than under the old system. Also, the other thing that you need to see here is the top rate in the program has also come down to $12,000 per year. So for those 3,000 policyholders who are seeing the top increases in the program, none of them will see more than $12,000 per year. So in effect, on April 1, they're potentially going from an $87,000 rate in the future down to no more than a $12,000 rate, a $45,000 decrease under the new system. Even though they're in the highest category, they're not paying more than $12,000 per year. And the actuaries at Milliman tells us that's in line with the losses that the flood insurance program is paying. The thing you need to know, how does FEMA come up with insurance pricing? They have to cover their costs. Congress requires them to cover their actuarial costs. They have to, on average, over the long run, be paying out about as much as what they're taking in premiums. They're not there. They're $1 billion off. So under the new system, they're going to increase to that number much more slowly and have a limit on the policy that's based, a maximum limit that's based on science, and is reflecting the fact that they're not going to see properties that are seeing $87,000 premium losses. So to give you a sense, the previous system has been replaced. The new system meets the 3 criteria that have been put forward by the board of directors. And with that, I will turn it back over to Cindy.
Awesome. Thank you, Austin. Again, I forgot to mention in the beginning, but if you guys end up having questions or, things that you want to put in, we'll handle them at the end. So just put them in the question and answer as we go through this. And that way we'll stay on track and not, lose track of, we might be answering it again. We've tried to cover a lot of that stuff. Go ahead, Austin. So, what you heard Austin just talk about is that we saw under the old system, the legacy system, that policies actually, people got bills for $87,000 and there was no stopping it. I think the thing that surprised me, as much as I've been involved, I didn't really learn until this last year. I don't know how many of you are aware. Love to see in the chat if you tell me like, yes, I knew this. But if you are on a grandfathered policy, maybe you're paying $4,000 or $2,000 or something like that. Did you realize in the legacy system that it never quit going up? That every year that 18% or the 25%, was added and keep going up and up and up. I had no idea. So basically I make the joke. It's not funny, but if you put a frog in a pot of water and it's boiling, they jump right out. But if you put a frog in water that you're slowly turning up the temperature, they boil and die. And really, a lot of our homeowners were in this situation and not even realizing it. Again, so what we really are seeing by what Austin showed you nationally is that 23% of the people were overpaying, right? And so I just did some quick math for your area. Out of 96,000 policies that you currently have in place, 25,000, over 25,000 of them are going to see a rate reduction. If you look at people that are going to see $0 to $10, which is a total of $120 a year, that brings out of the 96,000, over 81,000 of the people you serve are going to see, a decrease or negligible increase. At the rate we're going, it's 2 gallons of gas a month, right? And so, again, we feel good about the progress that we were able to offer. Go ahead, Austin. So again, what you did see is that there is a new max. There's nobody paying more than $12,125 a year. What I will tell you, just again, to put it in perspective, out of that 96,000 people in Suffolk, Nassau, and Queens County, you only have 67 people that are paying more than $100 of what they were paying before. So again, it's very, very small numbers. And usually they're homes that have a high value. Again, we talked about in your area, 25,000 people are going to see a decrease, how we're now using property specific factors on an individual property. So again, you have some impact on your own insurance. And then we're going to talk about the ability to have a glide path and what that means. and that you don't need an elevation certificate unless it's going to help. So those are all improvements with the new system. Go ahead. Awesome. So what's not changing is, residential and commercial policy coverage is staying the same. And then we really, the wording here is not correct because it said the buyers can assume or transfer. It is true. The difference is if you had to do it prior, the seller had to actually agree to let you take over the policy. And there was a whole bunch of, credits and billing and those kind of things. Now, if you get a copy of the seller's declaration page and you're helping a buyer, they can take that information and then their insurance company can set that up for them. So again, the good news is that any glide path in place, they'll be able to maintain. So again, still the same maximums of 18 and 25% for primary and then all other homes. But the thing that's interesting, and none of us have a crystal ball, but when we looked back over the last 5 years, the rate had been going up about 9% a year. And so nothing in risk rating 2.0 changes the methodology of how they do increases. So over time, it may go to more than that, but it's capped at 18 or 25%. But if it feels all of a sudden like that's a really big number, that may be why, because when we did the research, we found that over the last 5 years, that increase had been more moderate than what the maximums were. You are still required to have flood insurance if you're in a special flood hazard area and have a federally backed mortgage. So nothing has changed with that. And then the community rating system, which applies discounts, now that'll apply across all properties, including X zone, which really didn't have the benefit of it in the past. And the elevation certificates are optional and really used if it's favorable. Go ahead, Austin. Okay, so we're talking about glide path, and some of you may be like, "What is she talking about?" So here's the best way to think about it. This kind of goes to that sample that we looked at research. If somebody was paying $3,000 a year right now for their flood insurance through FEMA, the NFIP policy, and they got a renewal in the mail next week, and it says their policy is going to $10,927. Or more, right? You can see how each year you're actually going to pay as it goes up. And I use the 9% average. So the numbers would go up faster if you went up, the max would be 18%. But the point is, this is really critical, I think, for those of us that are seeing, as the market gets more balanced and moving homes, someone that the seller has a $3,000 policy is going to be a lot easier to sell it for $3,270 than it is to tomorrow do the $10,000 again in all of that. So what it really does, in my opinion, being a realtor every day, is that after Bigger Waters, you can imagine that I would tell every buyer, let me tell you what happened in 2012. And someday the insurance rates are going to go up. And I hope we have a better system, but I don't know what it'll look like. But this is what it looked like in 2012. I had a client and overnight it was 14,000. And so it's hard to make a decision a lot of times on, homes. If you're like, that's what part of our economy can go up 700%. So what this did for me in knowing, and I hope that you can see that this should be helpful and comforting to your clients, is it gives you a planning roadmap, right? If clients get this now and they say, hey, this is going to be $10,000 in 15 years for flood insurance, I'm either going to pay off my house or I don't want to live there or whatever, they can make a different decision. If a seller is worried about the ability to sell the house in the future based on the cost of flood insurance, they can, never been a better time here in Florida. And Mary Ann was saying, you guys are the same in New York, is there are people that will pay and they will take that liability. As a matter of fact, my husband and I are under contract to purchase a waterfront home and the owner paid cash and doesn't have flood insurance. So on day one, my flood insurance is going to be $6,500 a year instead of what everybody else in the neighborhood that has, maintained it. So again, those things are there, but as a buyer, you look at it and you go, well, how do I feel? Can I afford that? And make a different decision if it doesn't feel comfortable. So with our code of ethics, we want people to have the information, but the biggest thing I want you to know is your client may get, they will get a renewal from their insurance company, and it's going to show what the true rate is. We've never shown it before. Nobody here knew that you could get a bill for 87,000, right? Nobody here knew that it was going up to 45,000 and there were people paying that. So, that's a shock. So if somebody is used to paying $3,000 and they get a bill and they open it up, it says $10,000, and they call you and they're like freaking out and saying this crazy flood insurance is messed up, that's where we say, get the facts, right? Get a copy of the declaration page, and then also have them talk to their insurance agent. But most cases, it's the information letting them know what the true rate is going to be. As you help new buyers, you're going to be able to show them what the true rate is going to be. And they can decide then, is this a good decision for them? Does it fit their mortgage, boundaries and their future financial situation? But the most important thing is don't let people freak out, right? Don't you freak out. We've been doing this now since September, just to give you an idea. And again, I told you I was at ground zero, and Florida was definitely concerned about the impact because we have the largest number of flood insurance policies. Austin and I have probably met with 20 state and local associations in the last 6 months. We have yet to have, and I'm not asking for them, but we have yet to have a realtor have a real issue or concern that we couldn't address, or consumers. In my own association, I check in every month. I'm like, all right, what's the impact? Are we losing deals? Is it affecting? They're like crickets. So again, I think the biggest risk we run is misinformation and people not understanding. And then somebody looking at headlines and thinking, again, going off on this is terrible. So go ahead, Austin. So just to give you an idea of what you might see, here is on the old system in a flood zone, there was a property that was worth about $400,000. And it sits on the ground. That's what slab means. They were paying $474 prior, and they're going to pay $893. Now they won't pay $893 this year. They'll pay $474 plus at most 18% if it's their primary, 25% if it's their other property. So just know that, again, these are giving planning rates, but nobody's going to it on day one. Go ahead, Austin. Yeah, the glide path takes effect with this. Okay, one area I want you guys to really be aware of is with the new risk rating 2.0, FEMA gave everybody a clean slate. So in everybody's rates, there says no floods, no issues, new day. However, if you are helping a buyer, you may want to be aware that there are going to be some happy people out here. This is an example of a home that had repetitive flooding, repetitive loss. And so their current rate was $7,280. Now, the value of the home is $229,000. So it's still a low value home, but their premium is going to drop to $1,978. So under $2,000. Okay. That's a huge drop. What you need to understand is under the new system, there's a 20-year rolling look at flooding. So when the next time the property has a flood claim, they're going to look at 20 years. So say next year, the property floods, they're going to look at the past 19 years with this year, and they're going to adjust it. So again, when you're doing your due diligence, what I like to do is, again, find out about the history and be aware, but otherwise you may have very unhappy clients that, feel like maybe they should have been told or known more. A seller can specifically request from FEMA their history. They are the only one. It is protected under the Privacy Act by the federal government. But there is a process they can do that. And as a buyer, if you are, write that into a contract, they can divulge that to you. Or if you're listing, you could decide. So anyway, just information for you to know and be aware of. And you may have some people that they're like, hey, it went down. Just understand it may not stay down. Go ahead, Austin. Okay, this is a property that is actually in my backyard. It was built in 1967, slips on the ground, pre-firm, so it was paying a discounted rate. As you can see, the home is worth $1.5 million, right at one of the worst, VE velocity zones and flooding risks. Excuse me. The premium they were paying was $2,488. Their new premium would be $7,669. Now, while that, again, nobody's going to $7,669 overnight. The thing that I noticed in my area, and you may find it in yours, because you have 25,000 of your homeowners and property owners that are going down, is I looked at what people were paying, that were paying the 2488, and I looked proportionally at what the person paying at 1.5 million. Again, it was a small percentage of the value of the property, and I could really understand the logic that went into the risk and the management of it. The other thing that FEMA's looked at and is that it's $250,000 of coverage. But if you have a claim on a $200,000 house, you're not going to even use $250,000 of the coverage. If you have a claim on a $1.5 million house that sits on the ground, the odds that there's $250,000 worth of damage is much greater. Would you not agree? Yeah. So go ahead, Austin. And here's another legacy one where you see an older home, 1900, small house. Again, really, these are the people that were way overpaying. Also looking at different kinds of risks, right? This, if I remember correctly, was like on a riverbank somewhere versus coastal storm surge. So they were paying almost $6,000. It'll drop down to a little over $1,500. And again, like I said, so I think the other part of this message is, don't be afraid to have this conversation with your clients. I mean, I continue to have access and be able to have quality conversations as an advocate for my clients, because as you've seen, for 81% of your people, it's great news. For the other portion, you know how to help them understand it, and nobody's getting that high rate. So be the voice of calm, be the person they value and turn to for these kind of issues, and let them know that, that's why you are supportive of the Realtor Party and the investment we make in advocacy. Go ahead. So as you go forward selling under risk rating 2.0, what I absolutely love is that I can tell people the truth and know that there's no big surprises or boogeyman under the covers, that they will know their actuarial rate. I know that buyers can now make better long-term decisions. And I will tell you that there are many people like myself. I'm buying this house and it's, after 5 years, I'll decide, right? But the equity and the lifestyle is something that I'm willing to make that investment right now, but they can make those decisions. I also just recently sold a house of somebody who, knowing this and having a storm and being, in a repetitive risk home prior to this, said, I'm done. I want out of a flood zone. And again, easy to sell that property in this market. So they're going to have a better idea of the cost of future flood insurance. They're going to be able to make mitigation decisions. And then also, just know as the renewal questions come up, that you work with an insurance agent that really understands risk rating 2.0. We have contracted at NAR an excellent person who can give good information, but just like our realtor community, where we often talk about, 10% sell 90% of the real estate and are the, most knowledgeable, there are a lot of insurance agents that have not yet invested the time or the experience into risk rating 2.0. And so you do not want to have your client get bad information. So just remember that. Go ahead, Austin. And, my first career was with IBM. I was a developer. And I told Austin that this is really like installing a new operating system, right? I mean, it's 1950s to 2022. And so realize that there's lots of moving parts. The amount of data he showed you that's into this is incredible across a whole, system. So no matter what you hear, if it sounds, scary, bad, emotional, just pause, breathe, and get the facts. And the facts I would say is always ask for a copy of the declaration page, because again, apples to apples, everybody's situation is different and it's so hard to know without that. But again, that's what we encourage people to do. Go ahead, Austin. So, again, I was saying, prepare your clients, change is coming. Some of them may have already seen it. Again, it's a great topic and a great conversation piece to give you a reason to reach out to your clients. NAR has provided a wealth of information, but they also put together a very nice handout for you to give to your clients to explain this. And the reason is, as brokers and realtors, we always want to be the source of the source. We are not insurance agents. Austin is constantly telling me like, stay in your box. And so as much as I know, I have to work sometimes to do that and remember that the insurance professional carries that E&O and all that liability to give them that advice. I would hate to be the realtor that tells somebody, hey, you can drop in FIP and do with private, and then private goes under or whatever. Like, that is not our conversation. There are options, and we can certainly let them know that, but make sure a professional is helping them. And, you know, just again, make sure that you have a knowledgeable insurance advisor on your team. I would start out by even if you heard stuff today and you're just curious about how do you get the history on a policy from a seller, what do they have to request, et cetera. Ask your person. If they look like a deer in the headlights, I would ask another one. And if they look like it, I would ask another one. So again, these are things that people that are trained on it can really help you and your clients navigate. The other one more thing I really want you to know is that the beauty of this system as well is that I used to have to wait till the very end of the purchasing to get the insurance because I had to wait on the elevation certificate and I had to wait on all this stuff. Realize now that you have the power. If you have a good relationship with an insurance advisor, they may even run the quotes for you before you make an offer or right when you're in the beginning. You'll then be able to see, does it mess up their, you know, loan parameters and the amount of, you know, that's going to add to their monthly payment. Is it workable? So for us as realtors, we're able to be so proactive in the beginning that, and again, not have clients of mine invest money into inspections, appraisals, and surveys that they don't get back to find out that it's not a good fit and they really can't handle that. So again, realize that's going to be a great tool for you going forward. Go ahead, Austin. I take every opportunity. You know, we live in a world of computers wanting to do our jobs, and some people think they can. And the one thing I appreciate about NAR more than anything is that our advocacy. I mean, if we were not fighting for issues, there's nobody else protecting the homeowner. There's nobody else out there worried about, is it equitable? Is it sustainable? And so this has been a 10-year journey that NAR has worked and partnered with a government agency, probably one of the largest ever, to have a seat at the table, to have a positive impact. I tell the realtors here locally that I work with, and I'm president of Women's Council, I go, let people know, like, I invest in this. I'm fighting for you. If you give $1 to RPAC, own it and be the solution provider and the professional to your consumer. You've earned that right, and continue to know, like, you make a difference. Again, get that information off of NAR and help connect them where they need. And we will continue to update information as we get it. But again, Austin will give his information and you guys can reach out. He can escalate to the appropriate channels. Like I said, he's got the bat line to FEMA. They've been really great to us. And so any issues or concerns, you know, if they're legitimate, we can help you like get the right channels. If there's something, you know, wonky, we can help kind of like clarify what that might be. So you can help explain that to your client. All right, Austin. This just starts to give you an idea of all the information that's out there. There is so much. I would really encourage you to spend some time and take a deeper dive. If you're in an area that you handle clients that are in flood zones and need to understand more of that, like I said, like I do on a regular basis, but it's all there for you. Go ahead, Austin. And then this is Austin's information, so you can take it down. He is a resource and happy to help. And I'll just answer a couple quick questions. Yes, Thomas, I did say the buyers are not allowed to find out about past claims. So it is protected under the government's Privacy Act. It's a congressional legislative law that was passed. Austin knows all the details, but the bottom line is there is a way. Once you're an owner, you may request it. So the challenge, honestly, I think most of us have in this market is when you've got 20 offers, you know, is the seller really want to go that extra step for you? As the market balances or switches, I mean, I can definitely tell you that'll be something super for me. And the FEMA flyer is where we just showed you. We are more than happy to give Marianne these slides that you guys can continue to go through it, ask questions, you know, find the information. And so I think that's the questions. Do anything else out there?
While people are thinking of their questions, so this is one of the concerns we're trying to address in the next 5-year reauthorization and reform bill, this idea that buyers don't have access to the NFIP claims history of property. So, I mean, think about home insurance. You can go to a clue report, right? The buyer can get that information readily, figure out, if anyone's made a claim or made a phone call to to an insurance agent over time. That's in a database. Buyer can get access to that information. In the home insurance market, they cannot get access to that information in the NFIP, and obviously that's a problem. And so the process right now, as Cindy described, is the buyer's agent has to ask the seller's agent to ask the seller to make a request to FEMA. Maybe the seller has some claims and there's a disclosure requirement in New York State, which you all are complying with. But it may be that there was a flood on the property before the current owner who's selling the property, before he or she owned that property. Maybe there was a flood. So in order to get that full NFIP claims history, you have to work through multiple parties in order to get the seller to get the information to then turn it over to the buyer. That doesn't work. That's not right. So we have worked with Maxine Waters in the House of Representatives. She is the chair of the Financial Services Committee, to add a provision in her bill, the next 5-year reauthorization bill, that directs FEMA to provide that information to buyers directly upon request. So you're no longer caught in the middle of a buyer trying to get information they have a right to from a seller who may not be interested in providing that information or may not have the time. Instead, the buyer can get it directly from FEMA. Now, this is a bill. It's a proposal. It's a piece of legislation. Congress has got to pass it. We're not at that point yet. We have sort of the language written, and we're continuing to encourage FEMA, the Congress, to adopt a 5-year reauthorization measure, including those provisions that provide access to buyers to claims data. So that's a work in progress. I just want to let you know we are aware that this is a problem and we are trying to fix it.
Well, Marianne, I hope that helps people out. And again, we're always here as a resource. Like I said, we do feel like the more people understand and know, the better that you can do for your clients. And I'll just give an example. We have an insurance agent locally where I live, because I told you I was at ground zero, and he has milked his 10 minutes of fame to like an hour of fame. And so every time he gets a chance, he says, the sky is falling and here's this terrible story and blah, blah, blah. And, the reality is, let's be honest, like everybody else, if you are a wealthy client, being self-insured is an option. Some of my clients have decided that for the return of the $250,000, they have it in the bank and they'll choose not to. So, not everybody needs insurance. And again, it's not a bad thing. And yet what we really see is the people who count on it to be able to have a federally backed mortgage on the lower end are, 85% of your people are benefiting, right? And so I think, again, hopefully that helps you feel comfortable and feel good about it. So like I said, I'd love to, in the chat, just hear if this was helpful, and do you feel better prepared to talk about this with your client and your peers? And I would encourage you that people that couldn't be here, please share this with them at your brokerages or your associations, because again, we're talking something that's changed after 72 years. It's a big deal. And so the realtor population out there, if it's not today, which, everybody's working, they definitely need to be aware as they go forward, because like we're talking about the nuances of it. Thank you so much, Marianne.
Thank you. So very informative. I encourage everyone to please go to lirealtor.com/Wednesday-webinars. This will be recorded. Cindy and Austin will good enough to allow us to record it. And those last screenshots, they're also sharing the PowerPoint. Those last screenshots with all of those resources that NAR has available to you, I encourage you to please go to that and share it. That was really, really very helpful. Thank you. I mean, so many, we were discussing before we started that with over 1,000 miles of shoreline here on Long Island, we certainly have lots of waterfront properties, and this was very, very helpful. Thank you both for being with us. And I encourage everybody to please go to the site and hear this again and tap into those resources. Thanks, Cindy and Austin.
Thank you.
Thank you.
See you again.